Welcome to Smart Finance 360, the podcast where money matters meet innovative thinking. Every week, we dive deep into the world of finance, exploring trends, debunking myths, and bringing you the latest insights from industry experts. Whether you're a seasoned investor, a financial newbie, or somewhere in between, this is your go-to source for becoming financially savvy. All right, welcome to another episode of Smart Finance 360. I'm very excited about this one because my favorite credit company in the world, CIC Credit, is here. We have Amanda Aragon. I would say she is, you could call her the National Sales Director, account executive, the gal who knows everything when it comes to credit. She helps our company scale so much. We run a lot of credit reports. I don't even know what the number per day is, but the customer service that they provide for us is phenomenal. She's really great to work with, and I just have really enjoyed being able to help consumers with their credit, working with a great company. So not necessarily, I would say, credit. She's a credit specialist, but not a credit repair specialist. Now, she knows how to help you repair your credit, but I'm not necessarily, don't reach out to her to get credit repair. She runs a credit company. So
thank you.
She'll be able to help you with that. So you've been doing it a while, this. How many years have you been in this industry?
I mean, 20, and then you could add like a 7 to it if you wanted to.
Okay, yeah, 20 out of 7, and then in the mortgage credit finance world, that's like dog years, so it's definitely done it a while.
I started when I was like 4. So
when you're right outside of kindergarten,
you get into mortgage credit.
There you go.
Yeah.
This is going to be a great topic because there's so many questions I have on my phone here as well about credit, and so we'll just dive right in. So real quick, let's just give a recap. What is the difference between kind of mortgage credit, consumer credit, all the different types of credit? And we'll just kind of dive there. And I got so many questions for you.
Okay. So, one, you have a lot of differences. So when you're running a credit report, and you're getting a FICO score with it, because in general, most people know what a FICO score is. They're looking for that score to rate them on some type of scale. The algorithm that's being used is different depending on what credit is pulled for. So when you send in an application to me and I say to you, what are you going to do with this credit report? You may say, I'm going to give them an auto loan. I'm going to give them a credit card. You're going to give them a mortgage credit report. The mortgage credit report is the hardest scored algorithm in the industry. So that's why you find score, right, to be lower or more conservative than if they've gone somewhere else. A consumer credit score is the not least hard. What would be the word?
I would say the more flexible, maybe.
More flexible, yep. So when your consumers go on and they go to annual free credit report and they pull their credit report, they're like, yes, I have a 780. And then you pull it and it's a 710. And then everyone calls and they're like, what happened? Well, they got a consumer credit score and you got a mortgage credit score. And obviously the mortgage credit score is based on the idea that you're going to make one of the largest purchases in your life. And not only does the company, but the economy want and need you to pay that back. So it's a tighter scoring model. So you've got car loans and insurance and credit cards, and they all run a slightly different algorithm, which is why you have different FICO scores that are all out all over the world.
Yeah, it's interesting. A lot of people will call back, my FICO's 800. You pulled the mortgage and it's 740. What people don't know is actually 760 in the mortgage world is like the 800. It's a perfect score. 740 usually is the best for rates, but 760 is great for rates and mortgage insurance rates. So a lot of consumers don't know that, but the key is you want to get 760. What are kind of the categories that helps you get good credit, like the pie chart? What do you have there?
So really a good portion of it is having great accounts that have been there. They've got a lot of longevity. So you want to have your available credit and your balance when you're looking at something like a credit card. You want your balance to be half of the amount of your available credit. So if you have $10,000 available, you want to keep that balance at about $5,000. And that's the general rule. I'll have a lot of people ask, well, can I mix and match? And sure, there's like a lot of variations in credit. So of course you could do 40% here and maybe a 55 over here, but the easiest way to say it is 50%. longevity is awesome. So if you have accounts that have been open for a while, people's first inclination is like, I'm going to go ahead and close that account because I don't need it. I don't want to use it. But really, if it's a good standing account, it's having an awesome effect on your credit. So you don't necessarily want to go and shut that down.
Yeah, that's good. I mean, I had one of my first credit cards with just Discover when I was in college 15 years ago. Holy crap. I was in college 15 years ago. Anyway.
I feel so bad for you.
Hey, you're younger than me, so stop.
That's right.
But I can't believe that I kept it open. What I did, though, is at the time, it only gave me a $500 credit limit.
Mm-hmm.
So I kept on calling Discover, putting in my income, and then it only gave me like $1,000. And I'm like, So like what I did is like every single, 3-4 months, I would request the limit just in case my wife accidentally spends it on something, it's not maxing out the card. Because like you said, you want to keep it under 50 at all times. So what people don't understand is you can call Discover or go online or Chase or whoever you're going to use. And the biggest thing I think people mess up on here of why their credit gets hurt is because they only have a $4,000 spending limit and they're at $2,500, $3,000 at all times. Yeah. If you just called Chase and said, hey, I need a spending limit of $8,000 and don't go and spend more, but like lengthen that. And now you can kind of stay where you're at the $2,000, $3,000 revolving every month. And then lo and behold, your credit's going to get a lot better. When you do request that, though, I get a question they ask, does that hurt your credit when you request for a longer line?
So not necessarily, but what you're going to see is that may come into play in your debt to income ratio, gotcha. Right? And then the
minimum payments at that point. And it's just making sure that you're staying on top of yes, although I've been bugging, I got a Costco card, Citi, I've been bugging them forever because whenever I go to Costco, it's like $1,000, I swear, for 10 things. But it's like my limit they gave me was $4,000.
Right.
My limit with American Express is like $100,000. So I'm like, please just give me a little more. And every single time they only give me about $2,000. But I'm trying to do it. But I noticed that my wife actually used that because, she buys stuff. And I'm hovering around half, 50% every single month. And my credit's going down because of it. So I'm like, I'm going to have to set this Citi card on the side.
Right.
Nothing against Citi on this piece, but I'm going to have to set this card aside until I get a better limit because my spending limit on that, I'm used to is $3,000 to $4,000 a month on whatever bills we have. We like to always use credit. We just paid for a water softener credit. I like to use that, but that $5,000 cost, I'm maxing out the card almost. And so you want to make sure you have that limit. So, I mean, that's a great thing that people don't understand. If you're new, though, let's say you're not new, if you're young, 18, 17, how can you establish good credit?
So I think I talked about this on social media. I am still a big fan of getting your kids a credit card when they're like as young as possible and then never giving it to them.
When's the youngest you could?
Okay, so I did this for my kids. I just tried to do this for my kids. So my daughter's 10 and they wouldn't let me do it until she's 14. My stepson at the time, well, she's 10 and I think I tried this like 2 years ago. So at the time he was 19 or maybe 18, I guess. And they put him right on and I was like, no, don't send the card to him. Don't send the card to him in college. He doesn't need it.
No.
Go ahead and send it to my house and he will just be on it. And I put it on an American Express that I had. I've had it for years and years and years. So for parents, if you have an account, a good standing account like that, I'm a big believer. Like add them on when they're 14 years old because I believe that's what American Express told me. They had to be 14.
That's awesome. I mean, we just ran credit. She didn't know she had credit at all. She's like, I don't have credit. It's going to be terrible. But her dad did that for her.
Mm-hmm. Yes.
It ran 800 mortgage report. She never had a credit card stuff, but now it shows like 6 years of he makes great payments. Now I would advise if you're a parent and you're not good with your credit, don't do that. If you're not good at making payments on time, don't do that for your kids. Because you're going to hurt their credit, right?
Anyone wanting to be an authorized user, really check into that account.
Yeah, exactly. And on tips while we're talking about this, what are some good tips for just payment forgiveness, maybe some things about late payments? Let's start there.
Okay, so one of the fun things that you can do, late payment forgiveness or even not account forgiveness, but mishaps in accounts maybe would be is the way I'm going to word it. So you can often call your creditor, and if you have a really good standing with somebody, you've been a client with them for 5 years or 10 years, you can say, listen, maybe there was a car accident or a parent was in the hospital or you lost your job for a month. and just say, it was just a really bad March. If you could help me. And a lot of them want to do that because they want to help you keep your credit in good standing, one, so that they can extend you more credit. So you may find that they are willing, if you've called your creditor, to help you out by maybe removing a late payment or, dropping off a balance or limiting a balance. One of the other things I tell people, so like, if you're going to pay off a collection account, just know that that's immediately going to drop your credit score. So I tell people, if you want to do anything with your credit score, you better get it all cleaned up 6 months before you go in to do it, and then don't touch anything for 6 months and work on it 6 months after you've made your purchase. Because it usually takes about 6 to 8 months for that credit to kind of level out again.
Really?
So I think that's an important thing. You've got, being added as an authorized user on an account is a great way if you do not have enough credit. But again, like my parameters for that, and this is not written anywhere, it's, I like to see the account that's in great standing. It's been open for about 5 years. The longer, the better. Yep. Again, that balance is at about 50% or even lower for that credit limit. But I know one of the things that oftentimes as mortgage people you got to take into consideration is that debt to income. I don't have to look at that side of it. So
yes, I mean, with the larger limit, if you have more and you're spending more, then what we look at is the minimum payment. So if someone could have a $20,000 credit card, but I'm not going to take that $20,000 against you. It's just going to be what's that minimum payment of that $20,000. Okay. So that's probably going to be like $2,500 at least, I bet. Yeah. But depending on the rates on the credit cards. That's definitely, that's great advice there. Another question I want to talk about is you said about what was it? Not the late payments.
Payment forgiveness.
Payment forgiveness, yes, that one.
Or so you do, and you have a lot of people who, or a lot of, at least I know credit unions here in Utah. We have a lot of credit unions who will send out a letter saying like, you don't need to make a payment in December, or I think sometimes they even do it over your birthday or
that's kind of cool,
the 24th of July, because it's like our state holiday. So sometimes it's a nice idea to take advantage of that. I don't support that too much, but if you are going to be late or you need some cushioning somewhere, skip that payment. Add one more payment onto your loan and take your $500 or your $700 for your car payment and tuck that in as a safety net somewhere if you need it. That's something some companies and a lot of credit unions will do. I know it happens here. As far as like the late payment forgiveness, again, just calling those creditors Chase or American Express or, Old Navy or whoever it may be, and just saying, it was just a really bad month. I've never had a late payment before. Isn't there anything that you can do? And just remember, you always get more honey, or what is the saying? Bees and vinegar and honey and... I'm getting old.
No. What is it? It's
you get more bees with honey and not vinegar.
Yes, there
we go.
Yes, exactly. With that, it's nice to do it yourself. Sometimes it's even better to do it with a credit repair specialist. But what's the hardest thing for at least a mortgage loan officer is it's so hard to find good companies because there's so many bad companies out there that I've seen where they just put you on a monthly retainer and then a year happens and then there's nothing.
Yeah.
So why is it so hard to find? And I found them. I finally have.
Mm-hmm.
How is it so hard to find the right credit specialist? Why is it such a hard place to find the credit repair people?
So, I mean, I think one of the things, to be honest, is our industry doesn't allow a lot of grace for it. So if for a CRA like myself, if I am notified or I find out anywhere along the line that I have a mortgage company that is giving a credit report over to a credit repair agency, they can automatically be shut off, like turned down and shut off. It is such a no-no. And the idea is because you're not supposed to charge a borrower for something that they can do themselves, which is what falls into like those in rapid rescores. But I have helped my own family fix their credit at no charge, obviously.
Yeah.
And it's not something they can do themselves. So I think because it's, kind of a no-no and the bureaus have put that out there, you have a hard time finding companies that are good and maybe not taking advantage of the consumers. And the other thing was you had so many of them open, in that 2008 era, that the only thing that they did was take every account and put it into dispute, which is one of the reasons you can now no longer have disputes to run Fannie and Freddie. I mean, that's one of the reasons.
Tough.
So, but it seems like it's weeded a lot of that out.
Yeah, I think so. I mean, finding the right professional for that it's been tough. I have to dig deep, but when I find a good one, I latch on to that good professional, that good company, because I've had times where it's like, oh, we're working with this law group or something, and then it's like 15 months later, score's the exact same, and it's like, oh, you guys, killing me. It's nuts, but it's always good to talk to a loan officer, because just even doing a quick soft poll's really nice, and a lot of people don't understand that it's not going to hurt your credit too much. Another question of a myth that people always say is, oh, I ran my credit report with ABC Mortgage, I can't do it with EFG Mortgage. What is kind of the things that you've seen that, how many times could they run a credit report if they were to shop lenders?
1,000,001.
And it wouldn't even affect it.
For the first 30 days, right? Yeah. You have your initial 30-day pull, and then you get that free grace period for 30 days. And at that point in time, they can go and shop lenders. I will say, if they leave the mortgage arena and go to credit cards and then they pull again,
then that can hurt.
And
how long do these reports last that they can have? So let's say I pull my credit on January 15th. How long can I have this credit report and get a mortgage?
Right. So it really depends on the lender or your mortgage company. Because I'll have some people say, let's say in the case you needed to do a rapid rescore. It's got to be within 30 days, because so much can change on that credit report. I have lenders that will take a report that's at least 90 days old, sometimes 120.
Okay.
So, I mean, a good amount of time.
Yeah, so that's good. So roughly you have options. If you run it, you get up to 30, 90, 120 days there. And then within that 30 days, now, when I tell people if they're going to run their credit, your credit can change after whatever reports come in after 15 days. So although it does get ran again, it can change throughout the process.
And it can be like every day. That's one of the things. It happens very rarely, but there have definitely been days somebody's pulled a soft pull. They called me the next day. I pulled the hard pull, and it's different, and it's not the same codes. And I'm like, yes, no, it's the same. This has changed, or this report is
something happened reported from Discover or whatever car loan stuff. Tell me a little bit about what, in your experience, of the leniency or the strictness between Experian, Equifax, and TransUnion. Who's kind of the one that you're like, the black sheep of the three? Tough question. Maybe you can't say that.
I just, Equifax is a little hard for me. Experian here is very much our med score. I have a lot of people back east that love TransUnion. Equifax.
Extra transparent. Yeah. I mean, I was curious at times, just because I have seen repeatedly. It's interesting how each bureau, do they have their own scores, algorithms that they have, or is it just?
So this is super interesting. FICO is the only credit score company that we're using in the mortgage industry mostly right now, right? We're trying to bring in some others, so we're getting some diversity. It's pretty slow going right now. FICO is its own independent company. So the bureaus, TransUnion, Experian, and Equifax, have to go out, make a contract with them, and those contracts can be at different pricing, but they don't vary too much.
Yeah.
And then they say, okay, listen, we're going to buy your score on every credit report for $6, $8, $10, whatever they've worked out. And then the algorithm is built by FICO.
Interesting.
You see that they differ slightly. Nobody ever discloses what the difference is.
Yeah.
But they do vary slightly. But FICO being its own independent company, they own that FICO score, they own the algorithm, and then they're selling it to the bureaus independently.
So they sell to the bureaus, and right now there really isn't much other competition out there. I've heard of Vantage or other things that may be coming out in the future. What do you anticipate in the next 10 years? What do you think?
I mean, I think we have to have another scoring company come out. we need the competition. We need the prices to drop. I mean, that's the truth. It
just helps. Competition is healthy, I think.
Yes. And I think it keeps you honest.
Yeah.
Right? If you're the only one out there doing all of the things, then
you can have whatever pricing you want. Who cares?
Yes.
There's no other option.
And you can have any algorithm that you want. The idea, one of the interesting things is that FICO is coming out with a new scoring model next year, FICO 10.
So them themselves are coming out with a new scoring model.
Mm-hmm. They finally decided, I don't think in my 20 plus years that I have seen FICO update their scoring model. Wow. We've always used FICO Classic. So going to FICO 10T is going to be really interesting. They say it's going to allow for 12% more loan approval.
So they're going to be a little more lenient, or maybe looking at the current structure of how people, because if they haven't updated that for years, I mean, the people the way use credit cards 10 years ago is way different than now.
Right.
I pay everything on credit now.
Right.
Back then, there was cash. I don't even know the last time I had cash. It's hard to find cash. I have to go to the ATM
anywhere.
And my PIN. Yeah. So I use credit for everything, or Venmo or whatever.
Yep.
So interesting. So you think it's going to be good?
I think it's going to be good. One of the things when you're doing a FICO score is it is a snapshot of this exact moment. A Vantage score, a different company, is kind of looking over a 2-year history.
Okay.
That's where the new FICO 10T is going.
Interesting.
So we're looking at a broader range instead of saying like, ooh, there was the late payment just right.
Late payment 2016, sorry.
Yes.
Bye-bye. So they're looking at it a little bit differently. That's really good. 12%, that's huge.
Yeah. They're going to score medical collections a little differently, be a little bit more lenient there because that is difficult. And of course, we knew a lot of medical collections have fallen off, under certain balances. They're going to look at student loans, rate those differently. So there's going to be...
Actually exciting, I think. I think that'll be good, especially because student loan debt's changed in the last 10 years, 20 years as well. I got to remember that 10 years ago is not year 2000, like I think. So 20 years ago.
Right.
Speaking of all the bureau changes, one of the biggest things that I've been seeing lately is tell us a little bit about some tips that people can opt out from trigger leads. And then how does that even happen? I don't do trigger leads, but how do I'm not saying, I'm not going to buy trigger leads, but people buy these things.
Get them.
How do they get them? How does it work? What's the process there?
Yeah. So trigger leads are a really interesting thing. So when you have your credit pulled, the bureaus who own that information, TransUnion, Experian, and Equifax, can sell it to other companies, other lenders, other brokers, if they so choose to do. It's expensive. It's not something that CIC Credit sells. And I don't even know if there's a lot of CRAs try to keep because it's a sticky situation.
Well, it's sticky and it has nothing to do with you really, so that's why it's tough. So so depending on they have some company pays something through the bureau. That is very interesting. And then obviously I guess probably the more you pay, the more info you get.
Yeah, sure. So you can I like this zip code in this area with this score, right? And so one of the things that we're noticing is I'll have people call and say, listen, my borrower got 75 phone calls and they are so mad.
Yes.
And I understand. We didn't sell that information. Your mortgage company didn't sell that information. The bureaus chose to sell that information, and you'll notice it hit different areas. So if you have somewhere that has a lot of housing, big companies opening up in that area and people moving in, then you're going to have a lot of trigger leads.
Zip code will be very important to them. Yeah, and I've seen it not just in the mortgage world. I remember even if with insurance claims, that happened. They're hedging their bets that maybe I didn't like the way the company did my claim, and I might be on the move to look for new insurance.
Yes.
I had an insurance claim. I had so many insurance agents call me. I was like, I don't even know they pull my credit or how do they do this? What algorithm do you have? So what is a good trick to be able to avoid this? Is there anything out there that can help you avoid getting these?
Yeah, so consumers can go to optoutprescreen.com. I'm sure you guys are smart enough to put a link in for it somewhere. But again,
optoutprescreen.com. Mm-hmm. It's free.
It's free. And you're just going to type in your first name, your last name. I just did it 2 weeks ago because I wanted to see it again. But it's good for 5 years, and it will ask you if you want to opt out. I thought, I haven't done this in a while. So,
yeah.
But I would say, remember that we want them to opt out at least 5 or 6 days before we pull their hard credit report.
So the best way to do it is when you're doing your application and maybe you're going to be looking at houses that next following weekend, do it as you're finishing the application, and then we can pull the next 4 or 5 days.
Or consumers just go there now. Just go there now and do it now.
Go now. Just do it.
Just go now.
Perfect. Well, Amanda, it's been a pleasure to have you on. Amanda runs CIC West, West, East, North, South, everywhere.
Basically everywhere.
And she's phenomenal. So I appreciate you being on this podcast. This was very informative. We'll have to have you on again when you get, your new role and everything that's going to happen here in the future. I'm excited for everything that you do.
Thank you.
Thanks, Amanda.
Guys.